Welcome to today's Explainer class. I am thrilled to be your lecturer as we dive straight into Chapter 2, Accounting for Investments, specifically looking through the lens of Circular 99/2025. We've got some really fundamental concepts to unpack today, so grab your notes and let's get right into it. Here is our quick roadmap for the session. We'll hit the classification of financial investments, dive into trading securities under 121, cover held-to-maturity investments under 128, explore investments in other entities, and then wrap it all up with some practice and review. So what are our goals for today? Well, by the time we're done, you should comfortably understand the Circular 99/2025 classifications. You're going to master the journal entries for trading securities, meaning the buying, selling, and provisioning. You'll also learn to account for held-to-maturity investments, correctly apply the cost method for other entities, and confidently set up those all-important impairment provisions. All right, moving right into Section 1, Classification of Financial Investments, Understanding the Core Accounts. Okay, take a look at how these core accounts are mapped out. In accounting, it is literally all about intent. Look at account 121, Trading Securities. The intent here? Quick flips, short-term purchase and sale for profit. Now compare that to account 128, our held-to-maturity investments, where the whole goal is to just sit on the asset until its contract term expires. Then we've got accounts 221 through 223. Those are your long-term investments in subsidiaries, joint ventures, and associates. And finally, account 228 acts as our catch-all for any other non-controlling equity contributions. Let's move on to Section 2, Trading Securities, Account 121, Short-Term Trading for Profit. So you might be wondering, what exactly makes a security a trading security? Basically, these are stocks, bonds, or fund certificates that you buy with one main purpose, making a quick buck off price differences. You're planning to sell them off in under 12 months, and you have absolutely zero intent to control or influence the company that issued them. But here is the absolute golden rule for Circular 99, so write this down. This classification is locked in at the exact moment of purchase. You cannot change your mind later just because the market takes a dive. Now, for the accounting principles of account 121. Initial recognition is always at historical cost. That means the purchase price plus any direct transaction fees to get it. You got to track these meticulously by type, quantity, and unit price. And if period end rolls around and the market price has dropped below your cost, you have to set up an impairment provision. For all these journal entries, you're working with a specific family of accounts. You'll debit 121 to increase your holdings, you'll use 5117 for revenue, 632 for cost of goods sold, and 2291 for that impairment provision. Oh, and any financial expenses hit 635, while financial income goes to 1551. When it's time to sell, you've got a mandatory two-step dance. Step 1, record the revenue. You debit cash or receivables and credit account 5117 for whatever proceeds you got. Step 2, record your cost of sales by debiting 632 and crediting 121. Now listen closely to this part. Even if you sell those securities at a massive, brutal loss, account 632 is still recorded at your original cost, no exceptions. That loss only shakes out later when you transfer your balances to the income summary account. Let's put this into perspective with some quick math for ABC Company at year-end. For their V&M shares, the cost was $80,000 per share, but the market dropped to $75,000. So that's a $5,000 drop across 5,000 shares, meaning, boom, we need a $25 million provision. But look at their HPG shares. The market price went up to $44,000. Since there's a gain there, the provision required is zero. We never, ever offset gains and losses between different securities. It just doesn't work like that. So the total required provision for the whole portfolio is $25 million. If they already had, say, $10 million sitting in account 2291 from before, they'd just debit 635 and credit 2291 for the remaining $15 million. Easy, right? All right, let's transition over to Section 3, Held-to-Maturity Investments, Earning Periodic Interest. Let's do a quick side-by-side of our two main investment types so you keep them perfectly straight in your head. Trading securities, account 121, are for quick profit, usually under 12 months, mostly stocks, and they use account 229-1 for provisions. On the flip side, HTM investments in account 128 are things like bonds or treasury bills. The entire point here is that the company has both the intent and the actual financial capacity to hold them all the way to maturity. And for HTM, remember, we use account 2292 for loss provisions. Now, when you buy bonds, you almost never buy them exactly at par value. You're usually buying at a discount or a premium. The core of this accounting treatment is amortization.
Think of amortization as a gravitational pull. It gradually pulls the carrying value of account 128 right back to exact par value by the time maturity hits. If you bought at a discount, amortizing it will actually pump up your interest income in account 515 every period. If you bought at a premium, amortizing it is going to drag that recognized interest income down.
Moving right along to Section 4, Investments in Other Entities, Long-Term Capital Contributions.
You are going to want to memorize this matrix. It perfectly breaks down the thresholds. Over 50% ownership, that gives you full control, so it's a subsidiary under account 221. Right around 50% with joint control via a contract, that's a joint venture, account 222. Sitting between 20% and 50%, that gives you significant influence, making it an associate under account 223. And anything under 20% with zero significant influence just gets dumped into account 228 as an other entity. And a quick tip, all of these use account 22092 for their provisions.
So here is a crucial point. When you are preparing separate financial statements under Circular 99/2025, you have to use the cost method. You book the initial investment at cost plus direct fees like legal advice, but here is the absolute golden rule. You recognize income in account 515 only when the investee formally distributes profit or declares dividends, not a second before. Also, be super careful if you sell off a piece of your investment. If you own 60% of a subsidiary and sell 20%, you're down to 40%. That means you've lost full control, and you must reclassify that remaining stake from account 221 down to account 223. All right, let's open up Section 5, Practice and Review. Let's apply these concepts. Picture this timeline for a hypothetical company, Hung Thing Co., in 2026. On March 1st, they buy 10,000 FPT shares to flip for short-term profit. That goes straight to account 121. 2 weeks later, March 15th, they buy 50 corporate bonds, totally committing to hold them to maturity. Boom, account 128. Fast forward to June 30th, they sell those FPT shares, which triggers our two-step revenue and COGS journal entries. Finally, on December 31st, they collect their bond interest and have to assess any year-end provisions. This is a great example because it mixes trading securities and HTM investments right in the same fiscal year. Okay, pop quiz time. Let's see who's been paying attention. Question 1. Why do separate financial statements use the cost method instead of the equity method? Think about it. Well, it all comes down to legal boundaries and the timing of income. In a separate financial statement, the investor and the investee are distinct, separate legal entities. Because of that, income can only be reliably recognized when the investee legally hands it over through a distribution. Let's try question 2. Say an entity buys securities with long-term intent, but 6 months later, they panic or just change their mind and decide to sell. Do they need to go back and retroactively change that initial classification? The answer is a hard no. Under Circular 99, classification is strictly locked in based on your intent at the exact moment of purchase. Question 3. Company A crushes it this year and earns a massive profit, but they haven't actually distributed any dividends yet. Can shareholder B recognize a share of that profit in their own report? If you were listening a minute ago, you know this is a resounding no. Under the cost method, you literally never recognize income until the dividend is actually declared and distributed. No cash, no revenue. And finally, question 4. When is a provision mandatory? And hey, can an accountant just skip one to make the boss happy and avoid reducing the company's profit? Obviously not. A provision is absolutely mandatory whenever the market price or actual equity drops below your carrying cost. This is the bedrock of the prudence principle. Remember, as future accountants, your job isn't to paint a pretty picture, it's to paint an accurate one. So when you're out there in the real world, what kind of financial story will your journal entries tell? Keep that in mind as you review your notes. Great job today, class, and I'll see you in the next explainer.